I do think markets are toppy. I was reading early this morning when I was coming in, David Swenson, who runs Yale's endowment, talked yesterday at the Council on Foreign Relations, and he separated the economy from markets. The economy is clearly doing very, very well, although it is a long recovery here. This is so far the only decade in history without a recession. So if we make it through the last couple months and 2 more years, that'll be the first decade in modern history where that happens. So it's been a long, the economy's doing well, but it's been a long run. But markets, no matter which market you look at now, whether it's high yield, whether it's equity markets, you know, the obvious lack of volatility, which everybody talks about, the number of days, this new benchmark everybody's looking at, the number of days since there was a 3% correction at an all-time high now. The number of days where the market's up or down only, you know, over 1%, you know, fewer than 10 this year, 40 last year, 60 the year before. So people feel good about markets, and I think some of that is explained by the economy. But I think, you know, one of the few benefits of getting older is having lived through these times. And it does feel, and this is what Swenson was saying, from an overall standpoint to me, a little like 99, 2006. I remember in 2006 at Merrill, having people say to me, there are so many pockets of liquidity that there couldn't possibly be a pullback. And then, you know, in September of 2007, we couldn't sell $1 of CDOs, and nobody could raise a CLO. So, you know, it does tend to change quickly when it changes, and I'm not being alarmist because it is ultimately tied to the economy, and the economy is doing well. But the markets feel toppy to me.
So what do you do if you have new money to put to work right now? Where would you put it?
You're careful, you know, and I've had this dialogue with, you know, with my new partners at Viking who are putting up a lot of the capital to buy Rockefeller & Co. and create Rockefeller Capital Management. You're careful on pricing, you're careful on things you buy, you're careful on the way you put the capital to work, and you just have to be comfortable and strategic over a multi-year framework. So, you know, if you look at asset management companies as a proxy, their stock price is a percentage of 52-week high, and you run down a list that some investment banker would create. 99%, 98%, 99%. You know, some great companies trading at, you know, very high prices. I won't even name the companies because they're great companies, but they're trading high.
Greg, the 99 analogy, it's just I'm trying to figure, I mean, you think back, I mean, you saw some of the multiples, not just on
for
the
companies that were
stocks,
not making any money at all.
GE was trading at 50 times or 60 times earnings.
Yeah.
I just, and then, you know, it was mostly, we think of it as a tech phenomenon, tech bubble. They were trading at infinity times earnings because there were no earnings. They weren't even revenues back then. So I don't think, I'm looking for the analogy. I'm trying to see what pocket of the market looks anything like 99, other than just the overall feeling that we're expensive.
Joe, I was talking more about overall feeling.
Okay, it's an overall feeling because Facebook, Google, Microsoft, you know, and those FANG stocks, Amazon, none of those are up on just bubbles of pockets of air.
You know, but if you take those 5 companies, Microsoft, Netflix, Google, Apple, Amazon, and Facebook.
Right.
They're now 15% of the S&P.
Right.
Now, these are great franchises, but when you start to get to that level of value, and by the way, there was an article this morning saying Amazon's going to $1 trillion, and maybe it will.
And is Apple expensive on a multiple basis?
You know, on a multiple basis with the cash on the balance sheet and you know, and you know, classic economic analysis, it doesn't necessarily look expensive.
Maybe 06 is better because we didn't know what was going to hit us.
And remember, if you also look back at these times, they started to run, and people started calling this sooner. Greenspan talked about irrational exuberance in 96 and 98, and it took all the way till 2000. Right. So I'm not saying that there's some impending near-term major correction.
Maybe it's a bond market.
What I'm saying is it's starting to feel toppy across asset classes. It's hard to find value in a traditional sense anywhere.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.